Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Weekly for Saturday, February 26th, 2022. We had another great week of shows, albeit in a short week for President's Day, but we kicked off the week with a look at retirement plans looking for increased flexibility. Let's take a look.
Yeah, it's a great question. It's different because of the clients. Our clients have done great work with their plans. It's an opportunity for us to aggregate what they're doing as a whole and communicate back to our other clients of how we're working with them and use it as a straw person for a lot of conversations. And so what's different about it? It's probably growth. Plans are growing both in size and in headcount. The plan this year represents $230 billion, and my favorite number, 1.6 million participants. And we've seen over the past 5 years that the plans have grown on median by 67%. So as they increase in headcount and in dollars, the data gets more and more rich year over year, and this year is better than last year. Yeah, I think the pandemic had an impact on it similar to what we saw in the marketplace over the past 2 years. So in 2020, when the pandemic first hit, markets went down. There was a change in focus, big focus on the CARES Act and how to be helpful to participants and how they got distributions, loans, be able to manage their day-to-day life. As the markets recovered by the end of 2020, we start to feel like we're back in a new normal. There were some hiccups, so we got into traditional plan management. And what we actually see now in 2022 is the headlines of unexpected inflation and those high numbers. We're having conversations of the assets in the plan, probably something we haven't talked about in 10 years, but what's going on with the assets they provide, more specifically, where the target date funds are near retirement, what the asset allocation is there, because those are the assets in which individuals, the participants in retirement, would take a paycheck and be most sensitive to what we're seeing in today's market. So the pandemic is, it's art imitating life. We're seeing that plan management is similarly following that path. Yeah, it's a great question. I think as kind of using the example of the pandemic, as we've actually reset over the past 2 years, thinking about what's important to us in life, in our job function, flexibility has been extremely important. And in my new role with NEPC as the head of solutions, I'm having a lot more conversations with clients on how they want to manage that plan, what's most important to their core business going forward, which includes tasks they want to continue or things that they want to outsource. So I guess the silver lining, if there was one that came out of the pandemic, was the fact that people are resetting what their responsibilities are and doing the things that they find most interesting. And these employers are looking to provide their participants the most rich benefits, but maybe flexibility on how they manage it, either in-house or outsourced. They are 100%, or I should say 97% they are. So 97% of our clients have a target date fund, and of them, 95% of them have actually picked them as the plan default. And to your point, being the old dogs, we remember when there were zero assets then in 2005, and now there's 44% of plan assets on average are in target date funds. And so I would anticipate they're going to continue to grow in importance over the next decade or so. It is diminishing maybe the usage of it for sure. They're equally important, obviously, from a compliance standpoint. We want to make sure for those investors that have a do-it-yourself mindset that the options are available. But the trend numbers are strong. We saw basically, you look at the inverse of the numbers we were talking about. In 2011, 72% of plan assets were in core lineup funds, and now we're down to 56 because it's a zero-sum game. As target date funds gain assets, the relative relationship of target date funds goes up. So what we're actually seeing in plan is that's a lagging indicator. So that 44% is what's happening at the surface. Under the surface, contributions are close to 60, 65, maybe 70% going towards target date funds. So that's 70 cents on every dollar every 2 weeks go to a target date fund, which means that 44% on average will eventually close there as they get new contributions. The turnover, the Great Resignation you mentioned occurs. We could see over the next 5 years that 60% of plan assets will be in target date funds, putting more pressure on those assets to drive someone's retirement, also putting more focus on fiduciaries on their importance for their participants. Yeah, the push that you mentioned is real, both by the record keeper who are offering these. We are seeing strong pushes by them from a marketing standpoint, but we've actually seen a slowdown of adoption. Over the last 3 years, roughly 37, 36%, now 38% of plans are offering managed accounts. So that says the majority of plans actually do not offer managed accounts if you think about the number in totality. And why has the growth slowed down over the past few years? There's been new entrants into the market. While we know that their competition may be 2 or 3 options per record keeper, so the barriers of entry are high, there is other providers out there that are signaling that the entry point for the managed account could be 15 basis points. And that's actually starting to set a conversation of there's a price war that's happening even off platform that's forcing these providers to reevaluate how they actually enter the market, and which is having plan sponsors who are deciding to keep on the sideline as that pricing war sets itself out. As we think about the conversation we just had on target date funds and managed accounts are quite similar, and where they provide a professional allocation for participants. If you think about it, it's technology that's enhancing. So we need technology to move a little bit faster to bring down the cost. And to answer your last part of your question, roughly about 4 or 5% of participants who have a managed account available actually use them. And so if we were to see price parity between target date funds and managed accounts, I would actually think that we'd see more adoption in managed accounts. And so that would be the interesting game 5 or 10 years from now, as the two of them actually fight it out.
And we also discussed how employers and their employees can re-engage with their retirement plan. Let's take a look.
Well, the Great Resignation is a real thing. What we found through the pandemic is 8 out of 10 people are reevaluating their career, their finances, and their retirement, really going back to basics. They want to invest more in themselves and their financial wellness. Participants in employer-sponsored plans, they're especially motivated. 69% say they intend to save more in their retirement plan. And over half of people that aren't participating are realizing the benefits of starting to participate for the long-term benefits towards retirement and their financial savings goals. And to address these needs, we've enhanced the participant site with the goal of being engaging, simple, and motivating so that they know where they stand, and most importantly, it's simple for them to take action. Yeah, the key thing for us when we did this redesign is there's too much clutter. We need to simplify. We need to make it easy for participants to take action and give them positive and prescriptive insights. So we started with the My Target tool, which is what we call in marketing a hero image, but it looks very much not only like a Target, but like the Apple Watches that many of us purchased during COVID to have our fitness taken advantage of and to improve it. So the same concept is there with My Target. Simplified view of investments. We got reaction from participants that they want to understand where they stand over time, and we need more graphs to make it simple and not use investment jargon. In addition, my next step. So you give me my target. What are the small next steps that we can help participants take actions to nudge them towards that goal? And in addition, make it easier for them to plan for their future by making it more prominent to meet with a retirement consultant through Click to Meet or update their beneficiaries. And last but not least, mobile is where it's at. And we've extended these enhancements to our mobile application as well. Absolutely, and agility is key. I talked a little bit earlier that simplicity is also key to drive actions and make it as simple and as possible to make those incremental moves. But needs of participants evolve, and we need to help them not only save towards retirement, but also to save for those goals that are prior to retirement and really balance that out. And we're doing this digitally through tools where we can target through campaigns. We also have analytics that we can actually see what participants are doing on the site, so we can do more of what's working and understand what isn't. The ultimate goal is to take action right away.
Well, we're halfway through a look at our best segments. When we come back, we'll look at the other half. You're going to want to stay tuned right here on BRN Weekly. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
It's not some magical number, and it's not something we just achieve at the end. It's a feeling of freedom to live our lives the way we intended, through the ups, the downs, all of it. This is financial security, and Lincoln Financial Solutions will help you get there as you plan, protect, and retire. This is Lincoln Financial.
Welcome back. This week we had a conversation about the difference between a mortgage broker and a mortgage lender. Let's take a look.
Yeah, I mean, again, with rising rates, a lot of people are moving to the sidelines to wait it out. That means there may be some opportunities if you want to get into the mix. The keys you want to have is definitely you want to have a solid pre-approval from a local trusted lender. Talk to the real estate agent, ask them, if you find some, nice ad online and you apply. Before you apply, ask your realtor, hey, what, this lender? What do you think? Because a lot of lenders will charge upfront application fees, and they'll tell you, oh, but when you close, we'll credit you back. What if you don't close? What if you don't qualify? You just lost $400 or $500, right? That's money that you can use for moving, for all kinds of other things. So the other thing you want to look for is a lender that's not going to charge an application fee, so that you're not being. Imagine this: like you go up to a car lot and you see a car you like, and the dealer says, "Oh, that's the one you like? I'll tell you what, give me $500, and I'll let you walk up and you can sit inside the car and let me know what you think. But if you buy it, I'll credit your $500 back." The car dealers wouldn't exist, but in the mortgage world, a lot of lenders do it because it's profit. They make money whether they give you a loan or not. So I always tell people, try to avoid application fees if you can. But to your point, the difference between a mortgage broker and a mortgage lender. So a mortgage broker is someone who's using someone else's money. What that means is they're not really a true lender. What they do is they have contracts with various lenders, and by definition, they're going to shop that and try to get you the best rates and terms. Now, conversely, a lender is someone who's using their money. They sell right to the agencies. They have underwriters on staff. They make their own decisions, whereas a broker is sending it out to another lender and relying upon their underwriters and their closing department. So it's a best of both worlds. There's great mortgage brokers out there. There's great mortgage lenders. And just like in the industry, there's probably some you want to stay away from. But questions to ask, right? So a couple things. Is there an application fee? If so, I'd say run away. The other thing you want to look at is pre-qualification or pre-approval. Pre-qualification means you tell them what you make and they pull your credit report, and it's based upon what you just said. Now, you might make, say, $150,000 a year, but you didn't tell them that you have $700 a month in child support and some other stuff that won't show up on the credit report. All of a sudden, now your debt ratio is a little bit messed up. Or maybe you co-signed for some student loans or had something else going on. So pre-approval, however, is actually a true pre-approval is underwritten up to the point of what they can underwrite. So obviously they don't know the appraisal and everything else. In some cases, you can even get that done on what's called a TBD, to be determined. So basically the underwriter is approving you based on your W-2s, your pay stubs, everything else. So as a seller, when you're looking at 40 different offers from different buyers, you can whittle it down to the top 5 that have a pre-approval from a lender that's local and one that's your realtor trust. The other questions I probably ask is just how long does closing take? What else? Any other expected fees? Like what fees are they going to charge? And then what we're seeing now because of rising rates, we're seeing some lenders push adjustables. With an adjustable rate mortgage, you're basically telling the lender for a slightly lower rate today, I'm willing to gamble and have a higher rate down the road. So you want to take a look at that and make sure you understand what are you giving up for just a little bit right now. And then the other trick is they'll say, hey, it's a fixed rate and it's a 30-year mortgage, but it's not both. And by that, I mean, it might be fixed for 3 years, then it turns into something else. So make sure you're getting quoted on a straight 30-year fix if that's what you want. But whatever terms you're getting, 15-year, 20-year, 30-year, make sure you understand all the nuances of the loan so that you're not jumping in, because it's emotional, right? And your realtor's like, we got to get that pre-approval. We got to get going right now. So you're rushing through and you may not ask the right questions, only to find out that, wow, there's 3 points associated with this and it's only fixed for 2 years. And then you want to leave, but if I leave, I lose my $500 deposit, application fee. So you choose your lender wisely. Our slogan I came up with years ago is don't make a 30-year mistake by choosing the wrong lender. And the whole idea was think about it. Think about your choices of lenders, realtors, everyone else that's involved in the process. I mean, obviously check online reviews, ask realtors who they like, who they recommend. In fact, a good question, ask a realtor, if you were going to buy a house or refinance a house, what lender would you go through? And that's a pretty good indication right there, right? Because if they're in the field, they know who the good ones and the bad ones are because they've been on both sides of the transaction as a seller agent, as a buyer's agent. But asking the right questions, everything else. And then just jumping into another topic, but related. If you're ready to buy a house, the first thing you want to do is make sure you have your W-2s, your pay stubs, everything ready to go, at least 2 months of your bank statements, everything, so you can send it to your lender to get that pre-approval. Then you want to contact, once your loan gets accepted or your offer gets accepted in the house, contact your HR department, your insurance company, tell them, hey, look, I'm buying a house. I just got my offer approved. I got to settle in 30 days. When my lender calls you, and by the way, this is my lender's name, here's who I'm working with, so that there's a lot of fraud out there. I need you to get the verification employment right away. I needed the lost payee change on the homeowner's insurance. You want to get those people on standby so they're not, because they don't really care if you buy a house or not, right? But if you tell them what's going on and they expect the call, then it's going to facilitate the process a lot much quicker, and it's going to be a lot more, just a better process for everyone all around. Yes, I mean, the biggest one's going to be wire fraud, and that's where someone either hacks in or just because you're posting on Facebook you're about to buy a house or whatever, they pose as the title company or the lender and say, oh, you're getting ready to close. Congratulations. I need you to wire the down payment, and here's the wiring instructions. And some people do without thinking. So you'll see any lender nowadays, their SIG file will have a whole disclaimer, do not send money to anyone without verifying it first. What I always tell people is, when anything, whether it's your credit card or anything, you should initiate the call. Don't just respond to a link or something or text someone sends you. Take out your wallet, look at the back of the credit card, call that number, and then you know who you're speaking with. Call your lender, the one you've been working with. Hey, I just got this thing asking me to wire the money. Is this correct? Most times we'll never ask you to wire money. Bottom line is we'll coordinate with you how that works. Some other scams too are just going to be basic ID theft. You don't worry about that. But the wire fraud, that's the big one. The other thing is not so much a scam, but financial, I guess, not so much financial infidelity, but just financial communication. We've seen instances where, one partner gets excited about buying a house and they go out and put a down payment on furniture and open a credit card, or they think, oh, wow, this is cheaper than renting. I'm going to go buy a new car, or, oh, good, I'm approved. Now I'm going to take that job offer, and they switch jobs midstream. What I tell people is for that 30 days, from the time that offer is made to the time you settle, don't do anything without talking to your lender, because you'd be surprised. Even charging something to your credit card could ultimately change a number of things. So be really, really careful out there about those things. But open communication with your realtor and your lender, that's paramount.
And we capped off the week, and by the way, it was America Saves Week, looking at how you and your family can build financial resilience. Let's take a look.
Of course. It's my favorite thing to talk about. So this is the 15th annual America Saves Week. And we say that the week is just a time for every individual, every American to do a financial check-in with themselves. But more farther than the week or beyond the week, America Saves is an initiative of the Consumer Federation of America. So we're very focused on consumer advocacy and privacy for all consumers. But the focus of the America Saves campaign is to help create better and more effective saving habits. A lot of the information that you hear about personal finances, a lot of really overwhelming for a lot of people. And so our goal is to make saving easier, to help you get excited about saving, reducing debt, and beginning building wealth. Absolutely. And you're absolutely correct. That is why we chose the theme. It's actually the first time we've had an overall theme because we have seen the ramifications of the pandemic. We get to actually talk to our savers and hear their stories over the past couple of years, and the kind of common ground among everyone is they don't want to be in this situation again. How can I better prepare for the next time? And we see that there is this movement to be resilient and to make sure that they're never caught off guard again in this way. And so we thought that it would be a great theme because that's what our savers are focused on right now. Yeah. So, those conversations that I was telling you that we have with our savers, a lot of our young adults tell us, oh, we know that we're supposed to save. We have no idea how to do it. And so one of our goals is to make sure that we start having those conversations earlier and that they are always age appropriate. And so we chose Save as a Family as a topic to kind of help us continue to start that idea of saving early and instilling that early. So we want to incorporate those hard money conversations from a very young age. And so that's why we're very focused on Save as a Family as a topic for America Saves Week. Yeah, so one of the resources we created this year is a kind of like a download where you can literally have your entire family's individual savings goal and then write out what your family savings goal is. So kind of encouraging you to start those money conversations. What are you guys saving for as a family? Is it a trip to Disney when it's safe, or is it a trip somewhere else? Or is there like something in the house that you want to add, maybe changing the garage into a playroom or something like that? So what's the family savings goal? And then what are those individual savings goals for every person in your family? What are they focused on saving for? So it also has some prompts for you as parents to ask them some questions to get them thinking about saving. So that's one of our favorite resources for Save as a Family this year. But if you go to americasaves.org, we have lots of resources around Save as a Family. There's one blog that's 5 easy ways to start your kids saving. And we have several different blogs in that nature, ways to kind of get you thinking about how to have those age appropriate conversations with your kids, teenagers. One of our initiatives here at America Saves is America Saves for Young Workers, where we literally work with summer youth employment programs that are hiring teens for the first time each summer and help them open up a savings account so they're saving from that very first job. So we're really focused on not just talking about it, but being about it and having that very tangible, like on the job way of savings for our youth and teens.
Well, certainly great segment. I want to thank all of our wonderful contributors this week. And that wraps up this episode of BRN Weekly. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the latest in lifestyle, wellness, finance, tech, so much more, and all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to see our latest content or search our archives? Well, check out our website. That's www.broadcastretirementnetwork.com. It should be right below. And also our streaming partners like Amazon, Roku, Samsung, and over 100 more. We're back again tomorrow for BRN Sunday. I'll be joined by members of the media, academia, and financial services as we analyze all the latest news and information. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes. Now is your opportunity to co-create content around any topic on the first lifestyle and wellness network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.